Hey everyone, Benji here from the Contractor Evolution Studio. So today on the show, we are doing a budgeting 101 style episode with my co-host Igor Trninic. And this topic is such a foundational part of any entrepreneur's tool belt that we just thought it'd be a good idea to have him on and go super deep on this subject matter. Now, Igor has a business degree specializing in accounting from the BD School of Business here in Vancouver. He has also been a super successful painting franchisee for many years within a robust franchise system. He parlayed that into working on the franchisor side for another 5 years, including the early development of what has become Canada's largest residential window cleaning company, Shackshine. He is co-founder and currently managing director of Breakthrough Academy, which trains hundreds of contractors and home service businesses that combined altogether do over $1 billion a year in revenue. He routinely manages large budgets and P&Ls that include millions of dollars in labor per year. So to say the least, he is no stranger to knowing the numbers. Some really big takeaways I got from this episode were the importance of dialing in your own chart of accounts that fit your business and your management style, rather than just kind of copy pasting what your accountant gives you without fully understanding it. He talks a lot about how to analyze last year's numbers, learn from them, and from there, make an intentional change to next year's plan. And lastly, what to do if you write a budget for the year, but you don't like the numbers it's spitting out. So listen close because this episode is packed with gems.
You're watching Contractor Evolution, where we unpack the systems, tactics, and skills you need to take your fast-growing contracting business to the next level.
You're here to learn what it takes to scale up, work less, and increase profitability. You've come to the right place.
Stay tuned to learn what separates the new breed of contractor from the old school, and welcome to your ultimate guide on the business of contracting.
Okay, so Igor, really excited to do this with you. We're going to talk about budgeting, unbelievably fundamental business skill, and I thought we would start with kind of an easy one for you. Why is mastering a budget such a sort of bedrock skill to get good at, not just for each year, but your entire career as a business owner?
Totally is, right? So when you think about your management and leadership tool belt as a business owner, there are a lot of skills that need to go into that tool belt. One of the most fundamental, a real bedrock one, is this budgeting piece, because so much of your strategic plan in business and all these things that you're going to go do throughout any given quarter, any given year are stemmed in financials, really, right? Business is an exercise of money, and there's a lot of elements to it. You got to take care of people, you got to take care of customers. But if a business isn't profitable, it really doesn't serve its purpose to its stakeholders, to its investors, and that can just be you. You can have multiple shareholders, but at the end of the day, business is a financial exercise, and it's your job. It's your one of your real primary jobs as a leader and as a business owner to ensure that the business is profitable. So as you go throughout any given year, any quarter, you as a leader are going to have to make important strategic decisions with your team. And what I find is that, and I see this all the time, business owners who have a strong financial plan, a very well thought through budget, are going to be able to be so much more decisive in their decision making. Right. And if you think about it, your job is really ultimately to make decisions. Is yes or no? Are we doing option A, B, or C? When are we executing on this? You're like a decision-making machine, really. Mm-hmm. And how do you make good, decisive, fundamentally strong decisions if you don't even have a financial plan that you're basing on? You can't, right? So as a leader, if you are to be strong, clear, decisive, and communicate well, you have to be rooted in your decisions right down to the financial level, where you're when you say we are doing this, it's because you've budgeted for it, you've planned for it. It just allows you to be so much more decisive. So I think that's one of the more really foundational pieces where it links up to your ability to just be a good leader with your people.
Without financial underpinnings, a lot of your choices are wishy-washy.
Totally.
You may have a tendency to kick the can down the road. You may actually, in front of your team, the optics of it aren't good.
100%.
You're coming across being we might do that, we might not. I'm not 100% sure yet. Let me get back to you. Just purely from a being in charge of your people in a really clear, really confident way. Not having this is kind of not a good look.
100%. And I'll give you some like kind of tangible examples, right? So like right now we're going through, for instance, like a very large like internal systems change, like the actual CRM. And there's a lot of technology that kind of circulates around that CRM. All of it's changing. And when I go to the team, I'm like, we are doing this and it needs to be done by this day. I know that because I've budgeted $120,000 this year and about $100,000 next year for it. So I know that I can confidently say we're moving forward on this, and it needs to be, phase 1 needs to be in by this date and phase 2 needs to be in by this date, because it's in my plan. I'm not second guessing myself.
It's totally premeditated.
Totally. I didn't come up with it the night before.
Okay. So decisiveness, what else?
Decisiveness is a big one. When it comes to people and payroll planning, that's another really big one. So when we're going to the people that are driving recruiting, I can say like, I need this roll in by June 1st. I need this roll in by September 15th, so on and so forth. And we can decisively plan changes to the org structure that I know that we need based off of the business's growth, because we budgeted for it. The other part is also when it comes to bonuses, raises, all that kind of stuff, like we can be way more decisive and clear of like, this is the performance of this person, and this is the type of raise they're getting. This is the performance of that person here, the bonuses that are available to them. So from like a people planning, org structure, payroll planning, bonuses, raises, all that kind of stuff, you can be so much more clear if you've actually really thought through this before going into a fiscal year. So I know I want to really talk about timing later around all this, but as you go into a fiscal year, thinking through this stuff is super important, because those are, again, coming back to a leadership and decisiveness kind of point of view, you can really only do that if you've thought through your financials well in advance.
Right. And so for like, you think about the context we're speaking to this from, most of our listeners are running fast growing businesses. They need to add key people each season, maybe a 100%. Few. Some of those people are going to totally deserve raises or different comp structures every year. Without this, you really lack the ability to do that. Or if you're doing it, you might even be doing it for the wrong reasons. Maybe you actually avoid making a hire because you're like, I'm not sure if we can afford it. I hear that all the time.
Yeah. You're driving a fast car with blinders on. Like, you've got a little bit of eyesight, not all of it. Right. Whereas there's a feeling as a leader of being fully eyes open. Like, I understand the numbers like the back of my hand, right? And it just allows me to be so much more decisive of like, yes, have this person hired by June the 15th, this salary, these 4 people get this kind of raise, these 2 people get this kind of raise.
Yeah.
Right? Yes, have this large initiative implemented, the spend is approved for July 15th, move it forward, $120,000.
I have this conversation a lot. Yeah, people are like, okay, so we are slammed right now. Our production plan is like, booked out 3 months in advance. We could really, really, really use a production manager, but I don't actually know.
Totally. I
don't know if we can bring them in, and I don't even know what to pay them. I'm like, oh, we're putting this off. And you're going like, man, you are totally bottlenecked right now. And it's because you're not sure who you can afford this year because you haven't given this enough thought.
100%, right? And that's one of the key points I want to make is when you think of like a good strategic plan, which is a whole other episode, and we'll really dive into that in its own time. But in order to formulate like a robust strategic plan for a lot of these kind of things, of like, one of our key initiatives this year might be to hire an operations manager, a production manager, or whatever. But if you've not thought through the financial implications of all that and how there's an ROI on that individual and how they're not going to be a cost, but an actual bring a return on investment to the business, you can't be decisive in that decision making, right? So that I think is a really fundamental point, and it really also does. It's not just people, but it's all those larger investments. Whether there are certain marketing initiatives, rebranding, diving into mass recruiting campaigns, getting into other capital investments on equipment, all this kind of stuff. It really like helps you to not have these jerk emotional reactions, but rather have stuff that's stemmed in actual numbers and data that's been very premeditated. Before we move on, I want to make one other really important point on this, which is your learning as a leader.
Totally.
Is super important. If you can only develop this skill through repetition, right? It's like working out or sports, staying fit, all that kind of stuff. It's not just a one and done kind of deal. One of the biggest benefits of doing this consistently is that you're able to regularly learn and develop year after year after year by being able to learn from your mistakes. and we'll dive into this later because it's such a big point. But what I want to illustrate is, so I've done, I think it's now 8 annual strategic planning sessions in a row, like robust, multi-day, early mid-December every year, going into the fall for the year following, and I've noticed there's also even, it's almost like subconscious in a way where I have like an uncanny ability to not just guess, but to be able to structure kind of the projections in certain ways where it even surprises me how accurate they are sometimes. And it's because of this repetition that's there. I wasn't born with any crazy innate ability. I've just done it so many times. It's kind of like, how can a basketball player, like a really well dialed in basketball player, literally close their eyes and bang out 10 free throws in a row? Right. With their eyes closed, because they've just done the reps. Yeah. Right. So it's that same kind of thing. I think, a great example is like last year, being at the helm of Breakthrough Academy and in the budget that we formed mid-December 2019, going into a crazy 2020 with coronavirus implications and all this kind of stuff. The end of 2020, we hit 100.1% of a very large budget that was planned out over a year ago before all those crazy changes. And we've pivoted and adjusted so many ways throughout the year. But you hit it within 0.1%. Yeah. Right? That's not by accident. Those are the reps that have led to that.
Well, a budget acts in a way as like a feedback machine.
100%.
Every single year, you draw it up. You say, these are the goals. Hey, this is the revenue I'd like to see. This is what I want to see in net profit. These are the initiatives we're going to have to execute to make that happen. And this is what I think we're going to need to spend in order to do all that. And then at the end, you get to review and see how accurate you were. And I bet 8 years ago, you're not coming in at 100.1. You're coming in at, you're 25% off. Maybe more. And that's fine. That's not the point. The point is you set a standard for yourself, and then you looked at the actual results and you see the gap, and then you can start to tweak over time.
100%. When Michael Jordan shot his first 100 free throws,
he missed a lot.
Right? And that's the deal, right? It's an exercise of reps. I got a question for you, Benji, but before I get to it, I just want to throw one more thing in there. I think budgeting and this whole exercise is so tactically important, and there's a lot of how-to steps that we'll get into here in a second. But I want to throw one other thing out there that's a bit more, we could call fluffy, but I've seen this year after year, and I do think it's a real thing. There's something powerful about saying you're going to go do something and thinking through it, right? It's not random. You've thought through it strategically, but you said you're going to do something and you put it down on paper, or in this case into your computer, and you said, this is the annual financial plan and structure. There's something to that happens in the world when you very clearly commit that to yourself and to other stakeholders in the business, and you're like, this is what we are going to do.
Mm-hmm. You're putting it out there for the universe's help.
There's something going on there.
I totally believe that.
Yeah, because I've seen it year after year. So anyway, I want to ask you a question. When you look at prospects and applicants to the Breakthrough Academy program, what is the difference between those that come in and have this mindset around operations with a dialed-in budget versus what we might call freewheelers that just go into the year? Yeah. Let's work hard. Let's do what we can. And then let's talk to the accountant at the end of the year. Right. Freewheeling.
See what happened. That's a really good question. Okay. So with the freewheelers, there's a couple things that I've observed. So the first is, I think a lot of the times business owners fundamentally misjudge where their profit centers are.
Totally.
And so you'll see entrepreneurs, they'll tell me explicitly, we do these types of jobs and these types of jobs, but this is where we make all the dough. This is where all the money is.
And it's cool.
It's cool. And then you're like, okay, we'll see. And then 6 months goes by, a year goes by, we start working with them. We track their actual numbers. We get really accurate job costing. We're monitoring their overhead. We're comparing it to their peers. Like there's a pretty high level of analysis that we go through to actually fact check that. And they're wrong a lot of the time. So here's a classic example. Like in landscaping, this comes up a lot. You'll talk to landscapers, and they are convinced that all their money is being made off of these big, sexy construction projects. They're building $100,000 front yards or $250,000 like landscapes for rich clients on
these
big
sweet
houses.
Features we made, man.
And they are. And like, let me be clear, they are sick. Like some of the projects that a lot of our guys and girls build are very, very, very cool. But when we look at the numbers, it's like their dinky little lawn mowing service that's making all the money, and they're barely breaking even on these big projects, and it's taking all of their time, all of their energy, all of this equipment. You're battling with weather, and all of a sudden, we've seen this a handful, like many, many times.
Because that's where the emotional
it's fun. It's
grounding
super
right?
Cool. Yeah, that's why they got into it in the first
totally.
place. So, and it's not to say like you shouldn't do landscape construction. That's not the point here. The point is like that you're actually misjudging where your profit is coming from. And you might think that this little landscape maintenance service division that's only got a few people and just trucks along fairly brainlessly for you month over month is like this, not a factor in your business. But now that we look at the P&L, that's actually where you're making all your money. And so what happens from time to time is people will totally shift gears. Oh my God, I didn't know that. Let's really develop this maintenance side of things and actually maybe
100%.
Crank it back on the construction
100%.
side. So that's a landscaping example. You'll see that in other industries.
But it applies everywhere, right? And to your
everywhere.
point, it doesn't necessarily mean, hey, like everyone should shut off
Drop
landscape
your
construction.
No, that's not what I'm saying.
We're just illustrating an example, but you see it in other industries, right? Like, is it commercial painting or is it your residential side, right? Is it storm and insurance roofing or is it retail? Construction, there's just so many different classes and types of work that are done. But I think the central point is like freewheelers will often be totally eyes closed to where profit's actually coming from. It's a really good point.
That's one.
Have you also noticed like these people making very emotional decisions that they get excited about certain things, right? Of like, man, we should really build this new brand or this website, or we should hire these two people because we're so busy right now. It's peak summer, right?
Yeah, we see, we kind of joke a lot in the industry about squirrel syndrome, or like you see a shiny object and you go chase after it. Business owners that don't have a really strong budget and a really strong financial underpinning are way more liable to those types of decisions. They get swept up in them a lot more easily. So massive equipment purchases that get made because they're busy for 3 months. And then they're stuck on a 3-year lease to pay it off, and they're 100%. Not actually using it as often as they thought they were. Making a big splashy hire that costs a lot of money because you think you need it. Oh my God, this CRM I just saw at this conference is so cool. We absolutely need it next week. It's like, no, you don't. Totally. So there's a lot of that type of stuff, and it's okay to make big capital expenditures, but if it's like, going back to the premeditated point, if you've not thought through this and connected to the strategic plan, it's kind of like it's going into a grocery store when you're really hungry. You're like, I need those hot dogs. Yeah. You're like, do you? So that's another one that I see a ton with the freewheelers.
100%. A big point. I remember an old professor, I think it was at some point in university, saying this, what gets measured gets impacted, right? That's another key point to this. And call it again, freewheelers are just people, if you just go into a year, there's no strategic plan, there's no budget, you're not gonna actually impact stuff, right?
Yeah, and you'll see that very, very clearly, just purely on a few KPIs, like their net profit percentage and their gross profit percentage. The guys and girls that track it, you'll see it, way higher versus the freewheelers. When we actually do start to track it, they're often really disappointed with how low it is compared to the people that are paying attention to that. So it's classic, what gets measured gets managed.
Totally. And a lot of things in life are like that. Budgeting is no different. It's just such an important one because everything in your business is built on that. So
nobody achieves a 16% net profit margin by accident.
Totally.
Right? It's done on purpose.
Just like how LeBron James doesn't achieve certain gains or certain improvements in his statistics without focusing on those skills, right?
Right. So those are some observations. I would love to just hear from you, Igor, on sort of some process related stuff. So tell me a bit about like when you're going into a fiscal year and you're thinking through what do we want to achieve financially in the next 12-month cycle? Like what are you actually doing?
Totally. Yeah. So in one of these sessions, there's a lot that happens over the course of, let's say, like 3 days in a cabin in the woods. You've got a wood burning stove on. You're there with the key stakeholders of the business. No, seriously, that's how we do it. You
can't write a budget without a wood burning stove.
So I can't. We've got projectors, computers, flip chart paper all over a log cabin. We'll get into the nitty gritty of strategic planning later. For this episode, we'll focus just on this budgeting piece, which is of course a huge fundamental part of those 3 days. Where I really start is number one, dialing in the chart of accounts. So number one, dialing in the chart of accounts. Most people I see have not given nearly enough thought to how they structure the P&L, right? So this is within your profit and loss statement, within your budget, essentially, like what are these line items and how are you categorizing them? And often what people have is a situation where their accountant has recommended certain ones. Right. Now, if you look at our company's year-end financial statements, like as they come in the actual like formal set of year-end financial statements, they're categorized in this super weird way that are for, the CRA in Canada, the IRS in the US, but that's not at all management.
Yeah, totally. It's done for tax purposes. That's how an accountant would think, but from a business management perspective.
Yeah, they'll call it advertising and we might have like $500,000 or more in there, but that's really like 6 or 7 key and very different items that I need to be budgeting for and tracking very separately.
Right.
Now an accountant will just call it advertising because accountants aren't great at marketing, but so it's, you got to really look at this critically. So back to, you're asking what I do is I even look now, I've dialed this in like a decade ago, but I'll even look at it every year and say like, is this the right structure moving forward? Do I want to split anything up? Do I want to combine anything? So I'm sometimes making little tweaks, but just to begin at the beginning, what I find most people like haven't even thought about it on a baseline. So really what you need to be doing and looking at is fully restructuring for what makes sense for you from a management perspective. So how are you categorizing your variable costs? How are you categorizing your fixed expenses within the fixed expenses? What are the buckets? Like how are you looking at like all the software that drives the business? How are you looking at payroll and salaries, all the vehicle related stuff, all the marketing related stuff, the recruitment related stuff? So how do you want to structure your budget where you can look at a specific line item where it's just go paid media ad spend in Facebook ads, Google ads, Instagram ads, whatever it is. But like, I'm just looking at that. I'm not bulking advertising, including SEO and branding and clothing and physical printing. Those are all different items. I need to budget for them separately.
You're going super granular, it sounds like, and
totally.
you're using language that you use within the business.
Exactly.
Yeah.
Yeah, as opposed
not
to
just like the templated terms that
IRS,
gives
CRA,
you. Yeah,
exactly.
Whatever.
Exactly. So I'm thinking what makes sense for me of how I want to think through that budget line by line by line, and then what do I want to know at the end of the year, and ideally, which we'll talk about monthly financial reviews, ideally every month, where I'm like, here's what we said we were going to spend, here's where we came in. Right. So that's coming back to the point. That's the first order of business. Dial in that chart of accounts.
Okay.
Yeah.
Okay. What next?
So from there, one of the things that I'm kind of doing is I begin with analyzing last year's results. So by the time I get to December, I've done, in my case, I've done a monthly financial review. I think business owners at the very least should be doing a quarterly financial review with their accountant, financial controller, bookkeeper, whatever size of business, depending on your size of business, whatever you have. But I've done every monthly financial review. So I've reviewed 11 out of the 12 months and I kind of know where December is going to come in at. So I'm reviewing the closing year's results and getting my learning, and I'm looking at the budget, what I budgeted for a year ago versus the actuals. And of course, I know that if it's your first time that you're going to go through an exercise like this, you obviously don't have that, but that's the really nice to do, to be able to reflect and learn from that previous year.
So here's something that here's an objection I hear come up a lot from business owners is they'll do They'll say something like this, like, I wrote a budget one year and then we were way off. Like it wasn't even close to what we actually spent. And so there's no point in making one because it's not that accurate. I'm not like, I clearly can't forecast. I can't predict. So what's the point? Like, what would you say to that?
100%. It's like when LeBron James shot his first 100 free throws and dropped 32 of them in. Did he ask himself, well, why can I only hit 32%? Right? It's when it's your first time doing it, like you are going to be way off. I was way off. Everyone's way off. This is a skill that is acquired like all other skills in life and business. And it's going to take you 4 or 5 disciplined focus years of doing this to be able to get to the point where you are going to be accurate. So when you do it the first time, are you going to be way off? I can almost guarantee it. Yeah. And, if you're smart, what you'll do is you'll learn from it. And at the end of this episode, I want to talk a bit about like one of the closing things that I do where I go and actually put comments on every part of the budget, which is my thinking of how I got to that, that amount, all the revenue items, the variable cost items, the fixed cost items. But when I go through those, I'll actually put in comments and formulas and all this stuff solely for the purpose of my learning next year. So you kind of have to look at it as like there's absolutely some benefit in doing this in the first year, but the biggest benefit is going to be in your own learning.
Year 2, year 3, year 4.
Exactly, because you're going to look at it the next year. It's compounding, and the year after, and the year after. And if you're smart, you're going to document your notes, and you're going to be able to look back at the previous year and be like, whew, I was way off on that number. What was I thinking? Okay, let me read through my comments. Okay, here's what I was way off. Now I know how I should go about thinking about this.
That's the feedback machine part.
That's the feedback machine, right? You're like, well, I said I was going to spend, $46,000 on subscription technologies and all this stuff, and I spent $92,000. How the heck is that possible? Man, I really need to think through this more. So next year, what I might start to do is I might create even a separate tab in a separate spreadsheet and actually map out all of my technology items that I know I'm using, the CRM, the labor, like the hours tracking software on my staff, the QuickBooks, the payroll software, like all this kind of stuff, right? But I might actually then budget them because I was like, man, I was way off in the previous year, right? And that's happened to me. That's really happened to me a ton.
Totally.
Right. And that's where
it's going to happen to everyone a ton.
Yeah. That's where this learning has really come in. Right.
Okay. So it's all about the reps. You're going to get it. You're going to be way off the first time. Go into it and like write the budget knowing that you're probably going to miss this by a wide margin. And it's not about year one. It's about like the habits you're building for 3 years from now.
Totally.
That's exactly a huge thing I think people need to hear about this. It's not like an immediate ROI. It's a long-term play. So,
100%. And sorry, before you move on, let me just make one final point from an example that's very front of mind for me right now. So I was very lucky. I've had a number, I would say probably 4 or 5 pretty very impactful mentors over the course of like 8-9 years in business. One of them, his name is Dave. One of the things I remember being really blown away about the way, like I'd be in the office there with him. We were building an organization together and in the window and gutter cleaning space. And one of the things he was doing, he owned and ran a very large painting company as well. And he had his bookkeeper, financial controller, I can't remember her exact title at that point, but she was in this very formal meeting in the boardroom with him. And it was like 3, 4, 5 hours once a month where they were doing the monthly financial review and they were looking at the actual results on the month. So this is like, let's say March the 10th, he's doing the February financial review with her and they're in the boardroom with it up on the big screen TV and they're looking at every line item, the actual results and clicking into it, looking at all the transactions that are listed within there. So, and looking at the actual results versus the budget for that month. Mm-hmm. And I was like, man, and he did this like religiously. It was like it was pre-scheduled for the year. It was all the time. And I was like, man, he must be learning so much stuff about like, what was I thinking going into that budget? Okay, here's where it happened. And it's weird because you do it over and over and over again. And over the course of 3 years, you're doing that 36 times, right? This like 4 or 5 hour meeting. And after 3 years, he's got this uncanny ability. He'll be like, this is going to come in here.
With an unbelievable amount of precision.
Totally. Yeah. There's just so many reps, right? So that's that kind of learning piece that I think is so important.
It's really good.
Yeah.
So speaking to the chart of accounts, one thing that comes up a lot is there's confusion, widespread confusion around like distinguishing certain categories. So is this a variable expense? Is this a fixed expense? Is it something in between? Like,
Totally.
how do you go? Are there any rules or any insight you have around sort of allocating those to the different sections of your P&L?
Yeah, when I look at a P&L, my eyes automatically break it down into three categories. Like I visually just see three things, right? I see the revenue box, I see the variable cost box, and I see the fixed cost box, right? And to your question of distinguishing between variable and fixed costs, so just very simply, I keep it very simple. If I can attribute a certain cost to a job, like to a specific job level, it'll go to variable costs. If I cannot easily do that, I'll throw it into the fixed cost line items. Okay. Right. I'll give you some examples. So I ran a painting company for a bunch of years, right? So I've got a ton of crews. They're running around on different job sites. When paint, stain, primer, whatever gets picked up, they will tag a job name onto it, right onto the PO at the paint store. So they're at Sherwin-Williams or Dulux or whatever. It'll get tagged to a specific job name. The accountant will attach it to that job in our job costing system, and it'll go into a variable expense. Now, if they're picking up a set of just what we call like sundry supplies, so they're picking up like drop sheets, rollers, brushes, grates, cut cans,
Stuff you're going to use on any
stuff
job.
you're going to use on job. I don't bother trying to break that out.
Yeah.
Right. So I'll just throw it. I'll have a fixed cost line item for that kind of stuff. Now, is it technically a fixed cost? Are you saying like, well, if I do more jobs, am I going to use more sundry supplies? Technically, yes. An accountant might be like, well, yeah, that's a variable cost, but that one's kind of debatable. I err on the side of like, just keep things simpler, right? From that perspective. But there are big things like I can attach overall materials, in this case, paint, but it can be roofing shingles or whatever else. If I can say this, set of shingles went to that house, of course you can, then it's a variable cost. And of course you're estimating for it accordingly, right? Labor, absolutely. I can attach labor to a specific job. We're tracking hours, right? Hopefully you're using some sort of like hours tracking software, right? You can attach those hours to the Mr. Jones job. Or I need to rent, I need to rent this 125 foot boom lift, right? This like Z125 or S125 or whatever it is. And I'm attaching it to that specific job for that strata or HOA. That's where it goes. Right. And the rental cost goes there. So I might have rental costs. I'll have materials. I'll have labor. But if I have trouble breaking it out, then if it's going to like, again, this set of drop sheets and paintbrushes and rollers or whatever, this is just a simple example. But if it's going to be used between the next 50 jobs, I'm not going to bother trying to break that out. So that's that one. Where people really, now coming back to your question, one of the areas where they get really confused is around labor, because there's two completely different kinds of labor. Yeah. Right. You have what I'd call like revenue producing labor, which is in the field. They are holding a shovel or
on a ladder,
with equipment.
They're on the job site.
They're on the job site. Their hours are billed to the customer, if that makes sense, very directly. That is a variable cost. They're budgeted for in the actual estimate, right? As opposed to something like an office manager or an estimator. Right. Because they are a fixed cost line item. They're on a salary. Now, yes, they might have bonuses, which, by the way, I would keep in the fixed cost for simplicity. I would keep them. I would keep those bonuses in the fixed cost. But overall, those are two completely different kinds of labor. One is fixed when they're non-revenue producing, and most often they're salaried. Not always, but most often. And then you've got your field labor, which is a variable expense because it's revenue producing.
Right. What about some of those blended roles, like a project manager who is like working on job sites, but he's also in his vehicle sometimes and driving between them. He's not necessarily, got a hammer in his hand or a nail gun in his hand, but he is attached to the jobs, but he's also somewhat a manager. Like a lot of people have questions about that. Where do they fit in? So
my advice to you would be to budget for that individual's hours into every estimate. If they're going to be a part of actually driving the production of that job, you may want to think about having a cost allocation in your actual estimate, the way that you'd estimate for total materials, you'd estimate them right into the labor. And in which case, then you can allocate them at that job level into the variable costs. If their role is so management related, because production managers can be a pretty loose term. If they're
Yeah, it is.
so management related where they have no direct contribution to a job, then yeah, maybe you're not budgeting for them directly. They're built into your overhead structure.
Yeah.
But if it's a smaller business and you have this production manager actively involved in jobs, and it can be multiple jobs, then absolutely budget them in, bill straight to the customer.
Yeah. Okay. So here's another one I see people struggling with a lot is building a sales and production plan, like understanding how much revenue we're actually going to go out and sell and then produce. More often than not, it is truly a ballpark estimate. We did 1.6 last year, but things felt good, so I think we'll do 2 next year. And that they're actually not way off a lot of the time, but it isn't a super dialed in or super thought through approach. How do you go about building a really accurate, almost scientific revenue plan for the business?
Totally. When I say it's important to put something out there into the universe and the world, that wasn't exactly what I was talking about. We're guessing to it. I think we did 2 million this year. I think we could do 3 this year.
Yeah, totally.
Yeah, and you see that a lot. I think that there's a way more methodical way to actually think through that, where you're going to be significantly more accurate. This is not a feelings-based thing. Is you need to look at what is reasonable versus here's what I think we can grow by.
Yeah.
Totally different approaches. That's black and white, night and day, totally different. The way that I like to think about this is, so I've never had investors into a business. I've actually never built a business with $1 of debt even to any kind of creditors. But the way that I think about it is, if I had a group of investors and I had to stand in front of a panel, which you do for a lot of these kind of, if you think about companies that have a bunch of investors behind them, you have to stand in front of a panel every year and you have to defend the budget that you built as they go try to poke holes in it of why this? Does this make sense? How have you thought through that? And I like to imagine when I'm building a budget that I'm going to have to go defend it. Right? So I have to have some level of very rational logic of, if I say we're going to do 3.26 million in revenue this year, why?
You got to be able to defend it.
You have to be able to defend it. So what I like to do is to think, okay, how do I rationalize whatever number I'm coming to? Now, every business is different, but in your business how you get to revenue. In our contracting world, now every industry might be a bit different in whether you're doing more residential, commercial, roofing, construction, whatever. But ultimately, you've got to sell jobs and you've got to produce jobs, right? If we really boil it down, that's what it comes down to. You got to sell stuff and you got to produce work. So on the sales end, I got to think through, okay, this year, if I'm going to produce it, I got to sell it, right? We can't produce jobs that we don't have booked. How do I go about booking jobs? How does that happen, right? So I got to sign a contract, get a deposit, whatever. How do I do that? Well, typically there's some sort of estimate, right? So I say, okay, if I'm going to produce, I want to produce 3 million. Well, if I want to produce 3 million, how many jobs is that going to be? And well, guess what? If you look back at your records, hopefully you have a CRM. And if you don't, you've got some sort of job records, you can find out what is your average job size.
Right.
And of course, every job's a different size, but look at the last 5 years, add them all together, you're going to have a good statistical average. Your average job size is $15,426 or whatever. And you can say, okay, well, here's how many jobs that is.
Right.
Okay, so to book that many jobs, I got to estimate them first. How many estimates do I have to do? What am I closing at? If you have a CRM, it'll tell you because they're all in there, right? But are you closing at 28%? Are you closing at 76%? Anywhere within there, right? But you can figure out if I'm okay, well, if I want to do 3 million in revenue, I got to do X number of jobs based on my average job size.
Right.
If I need to do that number of jobs, based on my closing ratio, I need to do this number of estimates.
Totally.
Right? Is that reasonable? And here's the good thing. A year, this is what I think most people kind of head into a year, and it's this big, long span of time. I'm dude, it's only 12 months. It's 52 weeks. You know what you can get done in a week. Because you know how fast weeks go by, right? So what's reasonable? How many estimates are reasonable in a week? How many estimates are reasonable in a month? You know that because this happens over and over again. So you break the year down into these 52 weeks or these 12 months, and you say, what is reasonable from a number of how many leads am I getting? How many of those leads can I estimate? based on those number of estimates, how many jobs am I booking, right? So you're putting this rational thought, and it's not complicated. Break it down in an Excel file. I've got 52 rows or 12 rows if you want to do monthly, weekly, whatever. But put that rational thought behind it. But your key metrics are like, for a certain amount of revenue, how many jobs is that based on your average job size? How many estimates does it take to book that many jobs based on your success rate, closing deals? And then to do that many estimates, how many leads do you lose on, like what percentage of your leads do you estimate? How many qualified leads can you get from the market, right? So that's the sales side of it. So I'm thinking through rationally, come back to this point, I'm defending it in front of a panel of investors. And then there's a production side. Well, now we got to produce this work too, right? So in a year, it's only 12 months, it's only 52 weeks. And there's often some sort of seasonality more when we can produce more in certain times than others. But I'm looking at, if I've got in-house labor, what's my aggregate charge rate, right? So if I'm doing a $15,000 job, you look at in the way that you estimate how many labor hours is that based on the hourly charge rate that includes labor and materials. Everything's encompassed in that charge rate, right? But I go to the site and here's what I'm billing out my labor at. So you can see, okay, well, how many labor hours do I need to produce, right? How many employees is that? So what's reasonable? And if you're subbed, what is your sub capacity?
Yeah.
Right.
This is like all the interesting thing about a lot of the stuff, and we're throwing out some terminology here that maybe some listeners are unfamiliar with, but we could teach you relatively quickly what the definition of an average job size is, what the definition of a sales ratio is, what the definition of lead slippage is. Like these are just words that we've come up with to describe these things. But the point is, if you're looking at this stuff really closely, this is like grade 8 level math. It's just like
so simple. Yeah.
Times this divided by that. There's a percentage here. It's a very, very simple flow through to create these.
What was your revenue last year? How many jobs did you do in total? There's your average job size.
Totally. It's
simple, right? So all of this is very simple logic. I think the fundamental point is you're not just guessing. You're not saying we did 2 million last year, I think we can do 3. You're putting rational thought into, okay, well, how are we going to do 3? How are we going to sell 3 million and then produce 3 million? Mm-hmm. How many jobs do I need to sell? How many estimates is that going to equate to? How many leads from the marketplace do I need to do that many estimates? And then how am I going to have the labor to produce 3 million?
Yeah, you've created really clear marching orders for your business's divisions, basically.
Exactly.
Now,
right.
Are you going to follow it to a T?
No, you're not. But you've got a plan.
Right.
Right. It's like a military general, right? Like just because your plan is going to go off in battle, which you know that often it will, doesn't mean that you have no plan going into battle.
Not at all.
Not at all.
Yeah.
Right. You absolutely tweak, you absolutely pivot. This is why, and there's a whole other episode that we will get to, but this is why you do monthly or at very least quarterly financial reviews where you recap on all these stats, because otherwise you cannot learn. So
another one that we see misjudged a lot is variable cost, more specifically labor. Totally. A lot of business owners struggle to make accurate forecasts, sometimes to the tune of tens, if not hundreds of thousands of dollars, depending on the size. Mm-hmm. We think roughly we're gonna have this many hours to produce this much, and they can be way, way, way off.
100%.
How do you address that?
So very similar to this concept of like if you had to defend it. So what you shouldn't be doing is taking a big wild guess. Well, we spent 1.1 million on labor last year, maybe we'll spend 1.5.
Right.
There's always a calculation. And yes, every business is different. But what I want you to think about is that when you're estimating, you are estimating for these labor hours, whether you realize it or not. Because when you roll up to a house, like you do have some sort of estimating system and you're saying, well, I think that this is going to take, 126 labor hours. Right? And at the very least, you really should be, right? And you're saying this is going to be 126 labor hours, and here's the cost of this job. So right in there sits an implicit charge rate.
Right.
Right. So you can figure out if I'm doing a $15,000 job, here's my aggregate per hour, including materials, including all that stuff. So you know that data point, and you know this other data point, which is your your cost per labor hour for different types of roles that you have in the business. Now, by the way, don't forget to add burdens, because you have stuff like workers' compensation coverage. Every state and province has different pension plan, employment insurance. I mean, everyone's different, but let's call it an aggregate burden rate. So you should know what it is. So if you're paying a labor $20 an hour, it of course costs you more than 20. So now I know my exact, I know that it might cost me, if I pay them $20 an hour, it costs me $24.62 or whatever it is. So the exact percentage of burdens on top of that. But the point is you can actually look at, okay, here's all the different labor types that I have, right? So I've got my labor, a lead hand, a project manager, whatever. And you've got that list, and how much you pay them, what the pay scale is. And you can figure out with burdens, here's how much each of these labor hours costs me. And if I'm going to produce whatever's in the budget, 3 million, here's how many labor hours that's going to be based on my overall charge rate. So again, you're using very simple math to break that down versus just saying I think it'll be 1.5 million instead of 1.1.
Right.
So that's sort of you're asking about the variable cost side, but I will speak to the fixed cost side, because this one's also super important. People ask all the time, how do I know when I can hire this office manager, this new project manager, estimator, or whatever? I use just a very simple but very thorough spreadsheet of all the roles in the business, who's in those roles, and sometimes it's a question mark because you've not hired them yet. And then I budget for that salary for every month of the year, right? So I know if I'm hiring somebody, if I'm planning to hire this new estimator for June the 1st, so think about a spreadsheet, you've got all these columns, there's nothing in there for January, February, boom, boom, boom. But let's say you're bringing into them, and they're bringing them in on, let's say July 1st in the second half of the year there, and you've got, starting July, you've got their salary plus burdens accounted for right in there, right? So if they make $60,000 a year, it's $5,000 a month, right? Plus, so it's $5,000 plus the burden rate in your jurisdiction. And that's being budgeted for right in there. And every year when I'm in this plan, I'm looking at my full spreadsheet of all the employees and their salaries and everything. And I'm saying, okay, we're moving this person up by this much. We're moving this person up by that much. And I'm looking at that overall aggregate plan. Right. But cool. I will very often have an entire tab in my budgeting file that's just for salaried payroll, where I'm planning out their salaries, their bonuses, and then the breakdown per month.
Yeah. So not a ballpark at all. Are there, you mentioned fixed cost items, are there fixed cost P&L items that people either chronically overspend on, underspend on, or just don't understand very well?
Yeah, 100% there are. I mean, stuff that I see business owners, like in our space, not really thinking about are like recruiting, right? People think about how am I going to get my leads, and maybe a little bit they think about marketing, but I mean, we have, generally speaking, a shortage of people, more so than we have a shortage of work. And it blows my mind how little percentage of a budget is allocated towards recruiting, tactical, thought through, methodical recruiting practices where there's strategy and then ad spend behind. I'm driving, just like how you drive leads in marketing, I'm driving leads in recruiting.
This is a really interesting point, because if you were to survey, there's nearly 400 companies that we coach within Breakthrough Academy right now. If you surveyed all of them, I bet you 98% of them are going to say the bottleneck in my business is production.
Totally.
Nobody is going to say, oh, we can't find customers, we can't get leads. By and large, the phone's ringing off the hook and they're turning away revenue because they haven't got the bodies on the team to execute it. And so if you look at where people are allocating their time and energy, it's why are you spending all this time going and doing estimates for people that you can't even do and spending money on marketing for that, when the thought of spending $200 to have a top ad on LinkedIn or on Indeed is oh, I don't want to spend that money. It's there's a huge, there's a disconnect here between where the actual bottleneck is in the business.
Totally.
I see it all the time.
Yeah. If you're a larger business and you're fully recruiting, you best be spending $1,000 a week on between different pay-per-click ad, pay-per-click ads and things like that. So anyways, recruiting is a really big one. It doesn't get thought through. It doesn't get budgeted well as a line item of what roles are we going to need? How are we going to go about recruiting them in the next 12 months? And where am I going to need to spend on that? Whether it's a recruiter or HR support or ad spend or copywriters to build these beautiful ads and job descriptions and stuff, whatever it is, but you got a budget for that stuff and then spend it, spend that budget. Another one is accounting. Mind blowing how poorly people know their numbers and how little they spend on accounting.
Professional services to actually do that for them.
Absolutely. Whether it's an in-house accountant or an actual contracted accountant, but that's focused, right? If you're running a $3 million business, you better at least be spending $3,000 a month on the regular bookkeeping, plus a really strong year-end accountant, right? Like I mean, it depends on the business size, but I'll say like I spent significant money on actual tax strategy and year-end accounting. And that's the stuff that is going to keep you out of trouble, like serious financial trouble, and B, save a lot of money in taxes because of smart tax strategies. So again, a whole other episode. We'll get very, very smart tax strategists here at the table, but that's another area that's grossly underspent on. Coming back to your point, if you can't measure it, you can't track it, you're not going to impact it. So many business owners, especially in contracting, running the business with the eyes closed, just like this, yet they grossly underspend on this stuff.
Totally. I see that a lot. People will have, they'll have an office manager who's not even a trained bookkeeper and accountant doing a little bit of bookkeeping off the side of their desk. Totally. It's often late. It's often inaccurate. They often get overwhelmed because they've been tasked with such an unbelievably important thing. Totally. That they actually don't fully understand how to do. And the owner's just like, well, she does it. He does it.
100%.
It's like, how do you know that?
100%. I'll give you another big subject. How are you investing in the tangible value of your business, right? Things that come to mind, your brand, technology and infrastructure that you're putting in, right? If an investor, a new owner was going to come and buy your business, are you the business and is it your personal brand, or have you built a powerful and engaging brand that captivates your marketplace? Two totally different approaches. Right? In the last couple of years, I spent hundreds of thousands of dollars on branding, and I would look back at it and say, money super well spent. Right? But most people just budget for advertising in general. They're not breaking down like how much are we investing in brand, in SEO, in pay-per-click, into web development, truck wraps and signage, right? Like, are you? When I sometimes ask people like, well, are you doing this business thing or not? Right.
Are you just like going to buy leads off, Homestars forever?
Totally. Yeah. Right. We'd look at, I remember coming back to some mentors, right? When we're building a pretty strong brand that's now franchised all over Canada and now going into the US. I remember, he would look at me and we would look at some of these big expenditures around brand and truck wraps and all this stuff. He'd be like, well, are we building this business or not? Right? Are you in or are you out? Are you building a brand or not?
There's a mindset shift there.
It's a mindset shift, right? But anyways, it's around some of this marketing stuff. Same thing with technology, right? Does everything go through you, or do you have a robust and powerful CRM, payroll tracking, like hour tracking software? Are you implementing tools like Company Cam that allow company communication, Slack, Zoom for like, how are you tracking documents and forms and all this? Like, it can't go through you. Yeah. Are you building a real business or not?
Yeah, that's really interesting. I think a lot of you go to the brand piece. Like, a lot of people will like guffaw at a quote from a graphic designer to design a logo. Like, I'm not gonna spend $5,000 on that. Whatever, we're fine with just like this super crappy website and a phone number. It's like that. You are, whether you realize it or not, creating a bit of a ceiling for yourself permanently by
you
not
100%
investing
are. And the problem with these things is like people don't feel the pain today, right?
Right.
Like,
No, it's long term.
fine. It is technically fine right now. But long term, are you building a powerful brand, or is it just something that revolves around you build a landscaper?
Yeah.
Right. So anyway, those are generally some, but then I would just go through, like, I've spoken a bit to those, but regardless, like all of these fixed cost line items, I'm going through them all one by one, and I'm very methodically thinking through them. And this is an exercise that will go at least for a full day, right? But I'm literally going line by line throughout my entire fixed cost sections.
So, Do you have a sense for like what good actually is? Like, what are the benchmarks for a lot of these things? Like, net profit, for example. Like, let's just go super simple. Like, what is the standard? What does good look like for a handful of industries? What's a healthy net profit for painting, for construction, for landscaping, for roofing? That's a question that comes up a ton. People, maybe they actually have hired a bookkeeper and they have an accountant do the stuff at the end of the year, and they say, is this good? Like we have 6% at the end. I'm actually not sure if this is like what other businesses are doing. We don't talk to each other. We're totally siloed off. I never talk to my competitors. There's no textbook on it. I don't learn it on the job site. Like, what are sort of some standards for that number?
Yeah, I'll give you some general frameworks on what we're seeing. Like within Breakthrough Academy, there's about 400 companies in the program doing over $1 billion a year in revenue. So it's
decent sample size.
It's a pretty decent sample size, right? So healthy and strong, it'll depend on, I'll give you some kind of core industries within contracting. Now, it does, of course, really depend on your geographic area and the marketplace. It also depends on your split between like commercial, residential, that kind of stuff. But generally, painting will see 15 to 20% healthy in a healthy situation net profit. On the roofing side, we'll see in and around 15%, right? It does vary a little bit depending on whether it's retail or like storm and insurance, but generally around healthy, around 15%. Construction, really strong, 12 to 15%, like large scale construction, right? And landscaping, 8 to 11% on like the install, like construction side, and higher than that, at least 15, 20% at least on the maintenance side net.
Right.
So what I'm doing when I'm budgeting, I'm going through the variable cost line items and the fixed cost line items. And I try to, for me, one of the things I do, I try to not look at the net profit until the very end. I'm just going line by line by line by line. And I've been in many situations where I get through it all and I think I thought through it well. And then I look at the net and I'm like, sweet, that's where it should be. It's healthy. And I've been in situations where I go through it top to bottom and I'm spent like all day on this thing, sometimes with other stakeholders in there. And we get to the bottom and we're like, oh shit.
Yeah, this is not good.
This is not good.
I don't want to go have this year.
I don't want to go have this year. That's the exact thought that happens, right? I don't want to go and have this year.
So what do you do then? Like if you've gone through, you set up your little fire, your wood burning fire in the cabin, you've made the budget and you've gotten to the net profit at the bottom and you're like, whoa, we're going to with this plan, we're going to net 2%.
Totally.
What's the point of with all these people working this hard if there's that much left over for the rest of us? Like, what's the actual process to go back and tweak it or do whatever you do?
Totally. So what you do is you go grab some more wood from outside, you throw in the fire. You need it to burn a little longer. You grab some scotch, throw a few ice cubes in, and you go right back to the top of the budget. Right. So you go right back to the top. The analogy that I kind of think about it for myself is, an amplifier works, like very basics, right? So you've got a bunch of knobs. They control different aspects, like frequencies of the music. You might have sound. Exactly. Yeah, you've got your treble, your high, your mid, and the low, the bass. And that's what a budget's kind of like, right? So you've got the sound that comes out, which is your final net profit, is dictated by the combination of these various different dials. So I've got, use the example of the 3 dials on the amplifier. I've got 1 dial on the revenue. I've got a dial in and around all the variable cost items, and I've got a dial on the fixed cost items. And the combination of the position of those 3 dials is going to dictate how the sound comes out. It's just like that. The combination of the revenue, the variable expenses, and the fixed expenses is going to dictate how that net profit comes out. So what I got to do is I got to go back and tweak and adjust each of those dials right from the beginning to get it to where I need it to be. So that's why you add the wood to the fire, you grab some more scotch, and we're right back to the top. And I'm like, I need to find more room. I need to increase revenue a little bit if it's smart, if I can justify it, if I can defend it in front of that panel of investors, in my head. And I think through all the variable costs, and I think through the variable costs. Are we being not smart with certain expenditures? Right. And I tweak it to get it to where it should be. Because that's the point that you said is spot on. I don't want to go have this year. And I'll say this, it often doesn't matter for me financially, right? Like you might not try to live, it's not about how much money you're making. It's the fact that the business, if it's operationally excellent, it needs to make money. It doesn't matter how much you're drawing or not drawing at some level. It even if you're not drawing a lot and there isn't a cash requirement for the business to make a lot of money, it needs to operate at a certain net margin, because that is the margin of a healthy business. And whether you think about it or not, one day you will sell this thing. You're not going to die with it, right? And what is a buyer or any kind of investor going to do is they're going to look back and say, what is the financial track record of this thing?
Right.
And it needs to be healthy. You have a duty as a business leader and as an owner to get the company to hit a healthy margin.
Yeah, but when you're trying to achieve this in your budget writing, you're not going back to the top and just slashing things arbitrarily.
No.
You're looking for the low-hanging fruit. Am I
Totally.
right? Like you're like, okay, we could increase revenue. Let's look at the sales plan I've built. Oh, you know what? Like my sales team at this capacity is already maxed. Maybe
you're not adding to it.
Maybe it doesn't make sense to add to the sales
You're
plan.
not.
Let's go find where it's easier to reduce a cost on labor. Oh, you know what? We could fix the way we make orders on site and potentially reduce our material expenditure. Maybe we don't need to make that higher. Like you're looking for the easy
100%.
stuff rather than just like, well, we'll just bump up sales by 50%.
That's what you don't want to do. That's the maybe too much whiskey part, right? So you gotta absolutely be super smart in it. Like it has to make rational sense. Come back to the example. Imagine you're going to have to stand in front of a panel of investors and defend this budget. You still have to have rationale behind what you're putting out there, right? So then, yeah, it's like maybe we're not implementing this piece of technology this year. We're not buying these pieces of equipment or whatever it is. Like you have to be able to look at it and say, this combination of these three dials, the revenue, the variable cost, and the fixed cost is going to end up something.
This sounds good. This sounds good coming out of the amplifier.
Exactly.
I like this mix. Okay, let's go execute.
Exactly.
Is there a time of year that you should be doing this in particular, and how much time should we be carving out to do this really well? Is it something you can fit in between meetings or do in the truck? And like what time of the season is it optimal?
Totally. It's not done in the truck and it's not done in between meetings. I'll tell you what I found to work for me. So I've intentionally aligned the fiscal start of the year for January 1st, just because most people just mentally operate like New Year's is New Year's for a reason. We've been brought up that way. People just think in annual cycles on the, just January 1st to December 31st. So I've, set our fiscal year to that. So it's early to mid-December, anywhere between like the 8th to the 15th, 16th. I don't push it too late because of the holidays starting on the 24th. And I try to roll this out to the team, the full strategic plan by then. So for me, it's in and around there. It's 3 days. It's fully remote. It's fully disconnected. Like I'm not in the office. It's literally like at a cabin in the woods like you're fully focused on this. It's 3 days, at least a full day of those 3 days is dedicated towards the budget, building out what I call like the annual financial plan. From there, I do monthly financial reviews. They're about 3 hours. And then I do a really thorough quarterly strategic planning session with the key stakeholders. It's 2 days, at least half of a day is set towards what we call a budget retrend, which is maybe a bit complex, I think, for the time being, but we'll actually look at where the quarter came in, and then we'll make adjustments, what's called a retrend. We'll look to the end of the year so I'm saying at the end of Q2, half the year has gone by, and I'm doing going into Q3, my financial trend. I'm saying, okay, based on my best knowledge of what I know about the year now, where are we headed?
Yeah. So mid-December, and probably for the financial portion, it's a day. Like it's
exactly. But if your fiscal year end is end of February, New Year starts 1st of March, then you're probably doing it at some point early mid-February. So it depends on when your fiscal year end is.
Right. But it's as close to the end as you can go. So you've got as much data, but it's not so late that you're not going to have it prepared and done in time for the start of the next fiscal year. That's the important point. And then what do you do? So let's say somebody's listened to this, they've taken our advice, they go through the exercise, they write a budget, they go through a full 12-month cycle, they get to the end, and they are like nowheresville. Like their numbers are way off. They're out to lunch. Their sales came in at like 60% of what they thought it was going to be. They spent twice as much on materials than what they thought. Like it's just all over the place. It's a mess. What advice would you have for someone like that? What steps did they take?
Yeah, and man, I've had plenty of those.
So have I.
To be clear.
When
you look at it at the end and you're like, holy shit, what was I thinking?
What was I thinking?
Totally. So here's my biggest advice. is you have to get good at the skill of learning from your own plans. You have to get good at the skill of learning from your own plans, because that's how you're going to get better. You're going to totally blow it year 1. You're going to be a bit closer year 2. You're still going to be off year 3, but you're going to be even closer. But I promise you, by year 4, 5, 6 and onwards, you're going to be super dialed if you keep learning. Now, how you keep learning, I'll give you my key for this, is when you're building a budget and you're kind of putting in all these projections, the revenue, the variable cost, the fixed cost, what I do is in that spreadsheet, I use 2 things. I use formulas and comments into those cells. So in the formulas, I'll put in, I won't just put in the aggregate amount, $364,000. I'll use the formula of how I got to that. Right. So if I've got vehicle leases and I've got a bunch of trucks and vans, I'm putting each F-350, the first F-350, the second F-350, the F-150, the Sprinter van, the Transit Connect, like all these, each vehicle. And if I'm leasing them, I've got the monthly and annual lease implication, the cost of each one of those. And what I do is I right click on that cell and I insert a comment into that cell where I literally outline it, right? Like first
this is
F350,
what all these things are. Yeah.
Second F350, here's the lease on each of them. The 2 Sprinters, the Transit Connect, whatever you have. Right? I'm just using the vehicle leasing example, but I'll put that into the comments and then I'll put them into a formula equals this plus this plus this plus this. So if
rather than a sum total, so the mistake would be, I'm going to do this on a napkin over here and get my calculator and punch it out. Oh, and altogether it's 364,000 input. Don't do that. Actually put it right in the formula cell within Excel,
right in the
formula. You can visually see it a year later, because you're going to forget. You're
totally going to forget, because I've done this all before. Like I'll look back at it a year later and I'm like, it seemed very clear at the time when I put it in, but when I look back a year later, I'm like,
what the heck was I
off? But like, what was I thinking? How did I even arrive at this number? This number makes no sense. Like it made no sense. I think it made no sense at the time. It clearly doesn't make sense now, but yes, it did make sense to you at that time, but you don't even know how, so you can't learn from it. So comments into the cells of your thought pattern and your logic, and then write it into the formula. That's what's going to foster your learning when you really blow it in the first year, which you will. So that's that. I want to just add a couple other points in closing. We're getting into more advanced stuff now, right? This is a bit past just a very rudimentary budget, but I want to talk a bit about, like, if you're a bit more advanced with this stuff, you got to understand that there's no point of creating a budget and then having that budget sit as a well thought through spreadsheet file on your computer's hard drive,
right,
or Google Drive or Dropbox,
it's collecting dust on
collecting
the shelf.
dust. Exactly. You have to put it to some sort of use, and this is where these monthly financial reviews come in. I do them monthly. At least you should be doing them quarterly with your bookkeeper, accountant, financial controller. If you're Nancy, the bookkeeper down the street, doesn't even know what a quarterly financial review is, she shouldn't be your bookkeeper. And you should be spending money on it. The market allows you to budget money for it, spend it, right? It should be an implicit part of your budget, and you can still absolutely be profitable with it. But you got to be reviewing this budget on a regular basis. Otherwise, it's not useful. One other thing I'll say is what good leaders do is they give their team budgets. I know on the show we had Will Brown, and he talked a lot about how he implements Jocko's principles into his business. And one of the things he does is he gives his team control, right? And teams have allocated budgets for certain things because he's put them into his budget. So for certain things, there's these guideposts, right? Like people that deal with marketing expenses,
right,
sales related expenses, technology related expenses, certain like significant investments at initiatives. You might have your office manager that's overseeing a CRM implementation, or the implementation of a new like payroll and labor hour tracking software, or inter-team communication like Microsoft Teams or Slack or whatever. You give them that budget and you let them run with it. But this is the key thing, coming back to why do we budget? If I've not budgeted for this, how can I go give my team these budgets, right? So you give them these guideposts then that they can go stick within. So you're using this, you're actively using this budget to disseminate guidance to your team. So the point is don't have it sit and collect dust on the shelf. It's not just inside of your computer's hard drive or whatever as a spreadsheet. You're actively using it throughout the year. I reference our strategic plan, revenue plan, full annual financial plan, budget, labor planning, all that stuff on a very regular basis.
Yeah. So good. A lot of stuff there. I think some of the big takeaways for me would be do it knowing that you're probably going to be way off the first time. Get really, really good at tracking this stuff and do it more often than you think, and probably spend more money on bookkeeping and accounting and professional services than you already are.
Totally. You don't want to be driving a car blind.
Awesome. Let's leave it at that, man. Thank you so much for sharing all this stuff.
Awesome. Fun chat. And one thing I'm really looking forward to in future episodes, there's so many more intricacies and powerful concepts in financial management in that whole sphere of business that we can dive into. So I'm pumped for those.
We will get to all of it.
Awesome.
Hey, if you enjoyed this show, hit that subscribe button. It's what allows us to produce more awesome content for you, totally for free.